All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 10 of the Macro Corner podcast, proudly presented by Blue Line Futures. I am your host, Paul Wankmueller. The Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. My guest today is the one and only Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. Thanks so much for having me back on the podcast. I'm really excited to cover this week's topic, so let's get right into it.
Same here. The topic of today's podcast is risk asset pricing as a function of flows. And I do believe we have a nice quote to start today's show. Investment success does not come from buying good things, but rather from buying things well. And that was said by Howard Marks. He runs Oak Tree, and I believe that is a distressed asset firm, is it not?
That's exactly what it is. So
Right.
I think that he was speaking about that quote in terms of what investors are ultimately having to watch out for when they put capital at risk. And as we all know, markets run in cycles. And when you buy is just as important as what you buy. And so that's what this quote speaks to.
Absolutely. And when you buy it, that's true. So I want to get right into it here today. You know, the word inflation is on everyone's mind these days, going from the top asset managers down to, the person buying groceries at the store. But there are a couple other terms that I've seen floating around, and they are stagflation and stagnation. Now, what does that mean?
So when we think about the broad economy right now, we of course look back on a time of extreme stimulus over the last two and a half years or so.
Mm-hmm.
And as a result of that stimulus that was ultimately kept on for too long with the benefit of hindsight, we have put ourselves into a spot where we have persistently high inflation, and we'll ultimately find out the degree to which it cools or it does not cool, we'll see. But we have persistently high inflation right now. And then we have somewhat subdued economic growth. I mean, we had 2 consecutive negative GDP prints, and that ultimately, there's no real technical definition, but that a lot of people look towards it and call it a recession. So what stagflation is high and persistent inflation and low economic growth. So that's ultimately a composition of growth and inflation that does not favor stocks, that does not favor bonds. So the traditional sort of investment portfolio has an extremely hard time performing well under these set of conditions. So like you said, there are extremely large managers such as Bridgewater that look at this and call it a stagflation type of regime shift we're undergoing and ultimately position their portfolios that way. But then there are also the everyday man who goes to the grocery store and sees the price of food, the price of energy going up. So
Sure.
what this means is that there are different asset classes that would perform under stagflation much better than the type of assets that performed over the last 10 to 20 years. And that's ultimately why this inflation growth composition is so interesting at this conjunction.
So as you said, with 2 contracting GDP quarters, that would be the, textbook term for a recession. Is there such an indicator that is a textbook to determine stagflation?
There is no one single textbook indicator per se, but what we can look towards is the price of gold, the price of inflation-linked bonds. I mean, and also the price of real assets. I
Right.
mean, under stagflationary conditions, what you want to have as an investor is you want to have cash flows that are going to flow towards your portfolio in the near future, rather than investing in lottery ticket type bets, such as highly promising technology stocks that promise you future cash flows at some undetermined point. So when we look at sort of this one indicator, as you asked about, there's no one indicator per se, but there are a multitude of economic data and also the price of financial assets that ultimately reflect which type of regime we're in. And I mean, the stagflation type of narrative has had a lot of people anchor on growth slowdown, inflation remaining persistently high. And what the article at large from yesterday is driving towards is what a market's ultimately driven by. And over a secular time frame, of course, these forces matter a whole lot. But then over the shorter term, the market is ultimately a supply-demand mechanism.
Okay, and has throughout history, let's say recent history, have there been different countries or economies that have witnessed such thing as stagflation?
There have been a ton of economies, a ton
Okay.
of countries who have witnessed that type of economic backdrop. I mean, you turn to countries like Argentina. I mean,
Wow.
stagflation is ultimately one of the worst possible combinations that you can have as a country. Why is
Mhm.
that? Because you need to raise rates into an economic slowdown. And
Right.
that's ultimately the combination that drives down the price of risk assets. That's why a lot of investors at large coming into this year were so bearish and have remained bearish, because the worst combination is withdrawing liquidity from financial markets while the economy is cooling. When you look back over the course of history, you witness that really monetary policy is always this counterweight sort of to the economic environment. When the economy is hot, central banks raise rates. When the
Right.
economy is really cool, they try to be more accommodative. And in a stagflation type of scenario, that's not the case. There, in that type of scenario, you have both the economy cooling, but then at the same time, you have central banks fighting these persistently high prices, which is extremely negative for risk assets.
Gotcha. And talking about drivers of economies, and ultimately what it gets down to is people go to work to make money to buy goods. So if the goods are going to cost the employee more, the employee is going to go and demand a higher salary. And what I've seen last Friday, I believe the number came in at 585 new jobs. It was the jobs number that came out last Friday. And that was kind of seen with mixed reviews. But as we see here, the unemployment rate is 3.5%. So that keeps the labor market tight. But then again, we did see wage inflation come along with that. So I guess it was a kind of a mixed number. The market did react, the equity markets rather reacted initially negatively, but by the end of the day, and even today, we've seen some resilience with those numbers. How does that factor out going towards the future if I'm going to be paid more for my job, but then again, I have to go out and pay more for my goods, which I guess ultimately would hurt the company because they're paying me more. But how does that stop, or is that a loop, or what would you call that?
Yeah, so this was ultimately something inspired by a research piece that Bridgewater put out recently. And what they talk about is this feedback loop you have when it comes to income and spending. So if the income of people goes up, then you ultimately will see them spend more. And a larger degree of spending means that the supply demand dynamic is out of balance, and therefore prices have to go up. When people see prices go up, they ultimately go back to their bosses and going to demand even higher wages, which are then going to lead to more spending. And that's sort of the self-fulfilling prophecy that you have, where higher wages drive higher spending, which drives higher prices, which drives higher wages again. And what is so important within the current context is whether current inflation forces or secular, or whether the transitory camp still has an edge at this current point. And so when we turn to things like, you look at job openings, you look at
Right.
job quits, you look at the labor force participation rate, you see that the economy is sort of in a transition phase. And what Jim Bianco likes to say, he talks about a phase transition that we're still debating whether it happened, rather than looking for solutions for that new type of economy. You have things like work from home contributing, people not going to the office as often. Then you have different spending patterns shifting. And I have not personally taken a deep look at that particular phase transition and whether there's indeed a fundamental shift as it affects inflation. But one of the things we can look at, and one of the things we have a lot of certainty over, is again one of the topics we talked about in the past, which is demographics and the resulting labor force participation rate. Right. So if you have less workers in the economy, on top of less workers in the economy, you have the prices of goods going up that lead to workers demanding higher wages. You have sort of this double whammy going on where wages are going to go up, and you also have the people in the labor force, that number is going down. And that's ultimately one of the things that might be a secular driver of inflation, and this feedback loop within the wages and within the context of workers and wages really matters.
So with that aspect, the inflation, okay, is there a lag between this wage inflation feedback loop and unemployment, and is there a time period on that, or how would you describe that?
So when you ultimately take a look at what the Fed is currently doing, is they have this dual mandate between inflation and 2% average inflation and maximum employment. And what they try to do right now is they want to slow the employment piece of the equation in order to bring inflation down. And what they want to accomplish with that is, as they put more pressure on the labor market, as they ultimately force people to get laid off or to have less wage increases, they want to drive down inflation. And ultimately, the way by which they drive down inflation is they want to achieve a decrease in wages. That right. lead lag relationship between a weaker job market and weaker or lower wages is about 2 years, with a great degree of variance involved in that equation. I mean, giving credit again to Bridgewater, that firm did really good work on that. Mm-hmm. And they mentioned that there is this 2-year lead lag relationship there. And that's ultimately why, despite a weakening in the labor market that shows up in, say, the initial jobless claims, which we talked about last week, I think it was, and then you have still unemployment sitting at 3.5%. You had 528,000 jobs created last month. Then you had upward revisions the prior 2 months. So even if you see these numbers deteriorate going forward, which is ultimately what the Fed wants to see, then you still have that tremendous lag with which they want to impact wages. And I mean, we talked about this in the past too. I mean, there's a transmission process to central bank monetary policy, and whether their current actions can sufficiently impact that endpoint, those wages, that's an open question. I mean, that's not clear at all. And while they tout 2.5% interest rates as the neutral rate, and thinking that the current tightening might already have been enough to see at least anecdotal evidence of weakness in the labor market, which we do see in terms of headlines, in terms of tech workers getting laid off. But right. Then there's, of course, this massive lag. And when that's ultimately going to kick in is not nearly as clear as people might think.
Now, I'm just thinking out loud here. So if the companies have this dilemma, right, is this a catalyst for them to increase productivity in order to balance out those margins per worker, I guess?
They need to find ways to ultimately maintain margins.
Right.
And one of the ways is, of course, to lay off workers, because if each worker is going to cost you more, then you'll want to have less of them. And then you also have things like automation.
Right.
and different sectors and industries benefiting from that dynamic, which is reinforced by onshoring and friendshoring. So yes, companies will look for efficiencies. And I mean, the Fed ultimately wants to see that. The Fed wants to see companies lay off workers, which is ultimately going to increase the labor supply and decrease the labor demand. I mean, this is
Right.
part of this entire deal that the Fed is putting out there. Whether the economy is going to take that deal is a different question.
And that goes back to a few podcasts ago where we spoke about the wage inflation is different for different types of jobs. And from what I can gather, there are some jobs that are just not replaceable, i.e., a plumber coming to replace your air conditioner or your hot water tank or your toilet or things like that. But yeah, it's really interesting. And another way, I guess, to combat this cycle would be the change of multiples. We've already seen that. Especially in the tech industry, are risk assets able to trade at the multiples that they were? Maybe there's a reevaluation of what is a fair multiple to pay for a company earning XYZ.
Yeah, I mean, we talked about this off podcast before we recorded this, the Tina effect. There's no
Yeah.
alternative. And that was the case under a low inflation type economy where you had nobody who could really hold. Anyone who had excess savings, they didn't want to hold it in cash because you were losing on that,
Right.
even though on a low inflation rate. But then you could not really put the money in bonds either, because would you really want to get paid nothing to give the government your money? No, you didn't really want to do that. So there was no alternative but to put your money in stocks. And that's one of the reasons why over the course of the last decades, you've seen multiples go up.
Yep.
But now as inflation kicks in, as asset classes like real assets, like gold, like inflation-linked bonds, as these assets offer a more attractive yield, that equation has to be reevaluated. I mean, stocks are, and that also differs in between sectors, of course. But I mean, when we look at one of the slides in the chart book that we have today, it's slide number 6, where we compare the Russell 1000 Growth Index versus the S&P 500, and compare those two versus the dividend yield index as a proxy for value. And coming into this year, and for large parts of this correction in equity markets, we've seen value outperform growth because of what we talked about. Value stocks offer cash flows today versus growth stocks that offer cash flows in the distant future. And as stagflation fears sort of permeated through investors' mindset, value really gained traction while growth sold off. And what we see now is that starting mid to beginning of June, growth has started to outperform value again, because maybe some participants are reevaluating whether the economy is just going to be as bad as they initially thought, whether recession fears are indeed going to hit as bad as they thought. And these are all flowing into that equation, of course, as we look towards multiples. If inflation sticks around as high as it is right now, or settle in at a much higher rate than we've been used to over the last couple of decades, since the 1980s, basically, then yes, multiples will have to reset. But then the big question within that is whether indeed inflation is going to stick around. So it's all going to depend on which cash flows are going to be more valuable in the future, and which asset classes are ultimately going to be the ones that people will want to allocate towards.
Sure. And I think, we'd also talked about this where there are kind of the top 50%, the bottom 50%. And to group that together, I would say, we've had 2.5 times, you could say from, 2012 until, the high of November 2021, S&P went up 2.5 times, right? But has the average American experienced a 2.5 times greater increase in the quality of their life? I don't know. I mean, the other question is, if you did not own those equities during that bull market and you did not own a house, you're in a very different situation today than somebody that did. You don't really have that cushion to absorb the the prices of inflation today. So I think that, that's something to keep in mind.
Yeah, and that speaks directly to who central bank policy has really benefited. I mean,
Right.
we saw QE that was implemented during the Great Financial Crisis.
Yep.
That ultimately, even though the effects are not entirely clear, but I think an educated market participant would agree that QE and central bank stimulus is ultimately driving financial assets north. And because QE and and central bank stimulus was outpacing the rate at which the economy was increasing, that ultimately drove risk assets at a much quicker rate than the real economy. And the question now is, have we borrowed equity returns and financial asset returns from the future? I mean, when you look across cycles, really, the percent return of a financial asset really stays on average pretty much constant. And then the question is, in which time frame are you earning that return? Are you earning that return on an average basis the same way you look at the entirety of the return, or are you earning that return in a really concentrated time frame, as we've witnessed really from the financial crisis onwards? And whether the economy is going to maybe start to outpace financial markets versus what we have seen where financial markets have outpaced the real economy, that's another set of questions that we'll have to answer. And there'll be different financial assets that might do better than they used to under that type of scenario. But it's inconclusive at this point, I'd say. But then, yeah, I mean, one of the last things we want to cover in today's podcast is also money flows.
Yep. Yeah, I agree. I believe that no matter what, there are still going to be systematic buyers in these markets, and that is still an underlying bid rather, kind of gives a little bit of a floor. Yes, we do see flush outs in the markets, but at the end of the day, there's still money flows into equities and bonds, etc.
Yes, I mean, first off, you had this real phase transition from an actively managed financial market to a more passive world in which ETFs dominate, and different sorts of passive instruments. Whether that's going to be as good going forward, who knows? But speaking to the systematic aspect of things, Goldman Sachs expects that in an uptape over the next month, systematic buyers such as CTAs will ultimately be forced to buy $100 billion worth of equities. And one of the things we've seen is that macro hedge funds and CTAs have shown really little correlation to the US equity market, which means they did outperform in the current drawdown. But then because if the market shifts up and if things turn a bit more positive than maybe the worst expectations were, then they'll ultimately be forced to reverse positioning and buy equities again. So that's one of the things to consider. Yes, we are talking about secular forces. We're talking about things like inflation, like stagflation, like an economy that might not be as laggy compared to the financial market going forward. But then you still have the fact that a market consists of buyers and sellers, and those buyers and sellers have orders to be executed. And because systematic buyers will ultimately be forced to buy if the tape goes north in equities, that's going to be one of the factors to consider when you try to look at markets, equities in particular.
And just for our listeners out there, a CTA is a commodities trading advisor. Many of them use trend following models. That is why when you see strong trends in commodities such as energy last year, you saw it in the grains as well. That's where you'll see the CTAs outperform. When there is a market that is slightly choppy or going sideways, they say they die by 1,000 cuts as they try to buy the breakouts above and sell the breakdowns below. Yet if it stays in a sideways pattern, they will be forced to cover. And those are not the best markets for them. But yeah, like you said, if this downtrend starts turning around in the S&P and it starts pulling up, those guys will be forced to buy because it is systematic. There is very, very little human decision making going on in a lot of the CTAs. And if their system says to get long, they get long, and that's what happens.
That's exactly what we'll monitor. So yeah, I mean, this was a lot in today's podcast, but
Yeah.
I think we really covered the difference between what a market is and what economic data ultimately means for markets. So there's difference between secular forces, but then also considering the short to intermediate term when it comes to money flows.
Absolutely. And everybody, this Wednesday, that's going to be August 10th, we do have the CPI number. Everyone will be watching that. I believe 8.8 is the whisper number. For better or for worse, that is going to determine the market. And then we have Jackson Hole later in the month, which is a very large meeting. Jannis, thank you very much for joining me on today's episode of Macro Corner Podcast. This was episode 10, proudly presented by Blue Line Futures. I am your host, Paul Wankmueller. The Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. Thank you very much, Jannis. I'm excited to hear the responses from all of our listeners. Please give us a shout on Twitter, bluelinefutures.com, everything. Thank you very much, Jannis.
Yeah, thanks so much, everybody, for listening.
Take care.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.